Okay, hello and welcome to the second video. Today I'm going to talk about the portfolios. Which are available for monthly subscribers. It's the work of like last couple years. When I learned and researched the subject of fundamentals and macro, which supposedly drive the markets, right? I know that a lot of people, maybe the most people, are interested in trading intraday with technicals and like I'm also into it, but there was a point in my trading life where I really felt that I need to get more into the fundamentals, how it works, and the things that are supposed to be used by institutional traders, the macro traders and investors. And I've read, I've researched a lot of different sources of information, knowledge, education, and basically the one that really talked to me, and the one that I really started to understand the principles behind the macro-driven economies, was when I took a course with a lot of you probably know the guy who is ex-Goldman Sachs trader Anton Creel, and what he provides is a very detailed course on top-down analysis on the macro, on fundamentals, and how to read it and how to generate trading ideas based on not on technicals but on the macro data. The problem for me there is, once I started to get a grip on these things, it's like in my nature. I always try to automate things. I try to build the models. So like the main idea of these courses was to teach you how to generate these ideas, right? So it's not like automatic at all. It's more like having this mindset, this work frame that you start with, and look around you and try to find some investing ideas that would fit to your overall long short portfolios. And it's a really in my opinion, it's a really good course to start with all of these things, which we call fundamentals. But like I said, the problem for me was that I tested all these different things which are in this course, trying to figure out how to build some models, and it was a struggle. Like I used many of the concepts and then put it in a computer, and tried to make like an automatic strategy, and well, none of these these concepts were actually the ones that I could use in these models. So I researched more. I made like tons of different models, and then finally, after like, I don't know, like 2 years working with the data, with the macro data, it started to come together. It started to show up some pretty interesting results. And so what you're looking at here, and what you're looking in the Google Sheets portfolios, is actually the effect of my work on the macro side of markets. And the one thing that I want to point out at the very beginning is that right now you have access to these portfolios and the data through this Google Sheets. And so once you get the monthly subscription, then you just write me your Gmail, and I will add you to this to these sheets. But like I don't know, in probably this month, I will put it all into the Emini website, so it will be easier. And one other thing is, I understand that this is a bit of a mess now, because it's like it was a work in progress for many months. So you will see here a lot of things that are not actually usable anymore, or maybe not really that important, because I didn't clean it up like properly. So I will do it once once I transfer all of the important parts to Emini website. Okay, so I will try to really keep it brief as much as possible, because I know that I tend to record these videos, and they take like for ages. So I want to in this video, I want to like not talk much about how it is constructed, how it works under the bonnet, so to speak, but just how to read it and how to use it, and not really waste your time, because this is I guess what everybody is most interested in. So the basic principle of these portfolios is that we use only and specifically the fundamental data, which you can see in your economic calendars, right? So basically there is no technical analysis involved in it, like zero. This is purely based on the fundamental information, and it's also not driven by news by any means. It's just a raw data that is published, periodically for lots of different economic metrics, like jobs, like PMIs, industrial production, all these things that are supposed to be important for the economy in any country, right? Of course, there are different kinds of countries. They have a different place in a chain of a global macro perspective. There are, economies which rely more on, for example, on oil, or there are some countries which have like the largest GDP, like United States and China, for example, and all of this you got to take into the consideration when you're building a model like this. But basically, it's just, the model just analyzes the economic data. So that I think is important to understand, that there is no other analysis involved in it. Second thing is that because these are the portfolios, and the nature of the portfolio is that all the parts of the portfolio that I'm going to talk about, and which you will see in this video, and which you see in the Google Sheet, these are like integral parts which you cannot remove from the equation. Like, if you see that the portfolio, that the model tells you to go short on euro dollar, then you don't want to short euro dollar itself. Like, this is not how portfolios work. This is specifically designed to be traded together, because the nature of the portfolio is that some parts of it will hedge the other part at some point in time. Like, you will lose on one position, but make it up with some other positions. That's the promise. That's the that's the way how it should work, actually. So the first question that I get is can I use just one instrument from the portfolio to trade according to the direction that it shows here? And my answer is no. If you're gonna use the portfolio, you gotta use it as it is stated here, which means you gotta trade all the parts of a given portfolio, because we have different kinds of portfolios here in sense of how it is constructed and which instruments are in the portfolio. Okay, so the most important one is this dashboard tab, which will show you sort of like an overview of the things that are going on, and which are the most important here. So the tables which confuse most of you, are these ones with the direction that you should trade, because you have like four different tables here. So let me get into some details here. First of all, you will see that there is something like a base model, the R&D model, global macro real time. Yeah, I know it's a mess, but so here is the little bit of history. Like, we started building the all the model with some basic framework, which was supposed to work in any economic conditions. And this is actually the base model. So the base model is something that we started with after getting through Creel, getting through Dalio, his cycle, and a lot of different things. That was the model that I thought that that it's working properly in a lot of different conditions throughout many months or years even. Um, and and while it was okay, I didn't stop researching because as you know the whole environment and the macro landscape, it changes. Like it's not like it's changing. It's I should say that all the moving parts of this model, it's like there's I don't know, like probably 100 or 150 moving parts in it, and I was discovering them while I was going through it. So I kept the base model, which Creel was sort of talking about, and then build upon it and added or modified some of the parts. And what you see right now, where we at, is the R&D model, which is based on the base model, but it has some modifications that I believe at this point in time are the best, the best ones. So it's most complete. It's the most complete model, and in practice, what you want to look at is always look at the R&D positioning, because the R&D positioning is is what we trade, right? It's if it says short or long, then these are the current positions which I believe are the best. And at most points in time, it will be the same as the base model. But there are times, especially this year, for example, where the R&D model showed something different than the base model, and it's because I've added some protection features into the R&D model, which would trade a bit differently in some certain periods of time. Of usually it will be like some kind of a turmoil, or when the economies are doing so badly that the probability of central bank interventions are really, really high. And so the most important thing is actually this part here, the R&D. This will show you what are the positions in the portfolio supposed to be right now. Okay. Now, you understand that the base model is the groundwork for the model, right? And it will also tell you this, that it's right now it's 100% unanimity in between the base model and R&D. Now, this one here is, I don't really want you to pay too much attention here, because this one is somewhere in the middle between base and R&D. This is like a mid step between it. I keep it here because I like to monitor all the things for some time, which I've made, and the changes I've made over time. But it's obsolete right now. So some dates here are going to be exact, because this model also corresponds clearly to the base model and R&D, but please do not really use this table here. Now, the second one over here is actually the same as the base model, but it will show you like the real time, right? So it will change sometimes during the day, and it will flash different color of a position, but it's also not necessary to really pay attention to that. Why? Because the very important thing here is that even if there is some new data coming into the model during the day, the portfolios are constructed the way so you don't do anything until the market closes, the U.S. session closes, or somewhere around the close of the market. So even if, let's say, you have like 8:30 New York time, and you have a I don't know, like jobs report or something, and it will change the positioning in the model, and it will flash here sometimes that you have to change the positions. You don't change the positions until it is shown in R&D. It just gives you a heads up that something might change today, but you don't do any transactions until the end of the session. And because there is a very few transactions during the month, like one or two repositioning. Well, there were months when we had like 3 or 4 repositioning, because there was a lot of different data coming in, and there was some surprises or whatever, and the model switched the positions more than usual. But on average, it's gonna be like 1 or 2 repositioning a month, or sometimes it can take like 2 months for repositioning. It all depends on how the economic landscape changes. But like I said, this is the most important one, and it will change somewhere between, if it changes, it will change somewhere between the end of the U.S. session and like the first hour of overnight. You really have a plenty of time to get in the market, to reposition yourself. You can even do it like the next day, because it's not day trading. Okay, it's not like you have to be super precise with the entries. It doesn't work like that. You need to reposition your portfolio like not rapidly. You have a lot of time to do it. Like you like I said, you can do it even the next day after it changes. I mean, I'm not saying that you should wait one day, but don't worry about the speed of execution and precision here, because it's more like investing, not like day trading. It sometimes might look like swing trading, but it's really not. Okay, the second important thing, which is crucial here, is the all the instruments that are in the model. So I didn't say in the portfolio, because we have different kinds of portfolios, but the instruments that are taken into the considerations are over here, right? So you will see these are futures contracts for euro, British pound, Australian dollar, Canadian dollar, Japanese yen, gold, 10-year bonds, and euro stocks, and oil. And the way that these equity lines, which you see here, are constructed and calculated are based solely on single futures contracts. So there is no compounding here. I will show you compounding later, but there is no compounding here. Like the base size, the starting size of any portfolio should be one contract for all of these instruments, except the Canadian dollar, which is ×2. It says here like ×2, and the gold contract, which is half of gold contract. So you would have to use like 5 mini gold contracts, and oil, which is also calculated like a half of a CL contract, right? So so these are the only three that that have a different base value. And whatever if you would start with 10 contracts, for example, you would go in with the 10 euro contracts. You would have to have like 10 British pound contracts, 10 Australian dollars, then 20 Canadian dollar contracts, right? Because this is ×2. You gotta have your position to be balanced inside all of the portfolio. If you're using Canadian dollar in your portfolio, then you always have to have 2 times more of these than for example euro. And also, if you have 10 contracts of euro, then you would have only 5 contracts of GC, right? And only 5 contracts of oil, right? So this is one very, very important thing, because if you will somehow mess up the sizes that you're trading with, well, your equity, your performance is not going to look like that, because it's all weighted accordingly to to the tick size, to our margin size, and please do not really mess with the sizes. And if you have still trouble to understand what size do you actually need to use, then please contact me, or just rewatch that part when I explain it. Okay. Now, as you may see, there are different types of portfolio. There is a light portfolio R&D. There's a FX R&D portfolio. There is a global macro R&D portfolio, and actually there are more in portfolio vol.tab. Right, but we'll get to it soon. So, like the mother of all portfolios is the global macro portfolio. I'd say mother because it's got all of the components in it. So all of the instruments are in it, beside the CL, so the oil, because I added oil some time ago to see how it performs with oil. I'm not using oil at all, but it's just that some people asked if I could throw in a model for oil, and yeah, it is here. That is this. The equity is that green line here. So it says global plus oil, and without oil futures, it's the white line here. This is the performance of the portfolio, right? But I'm not really suggesting to use a global macro portfolio R&D with oil, because I don't actually I don't think I fully understand the oil market. The model itself, it shows the positioning of oil in a way that I have to say I'm not really content with it. Like I'm not happy about it. I don't feel safe trading oil in this portfolio, and you really don't have to. You really don't have to do it. So you can you can easily trade the global macro portfolio R&D, which are these positions here, excluding the oil, and your performance should be something like this white line here. Okay, so if you're trading futures, if you want to trade futures with these portfolios, to open these positions which are in a global macro portfolio, especially with nowadays overnight margins, because you hold your positions for weeks or even months sometimes, then the margin is pretty high. So like for a global macro portfolio, the average margin which is required for these positions to be opened is over $30,000, I think, right now. So it's a lot of money to to have upfront, to open these positions. And that's why I've made different combinations of this R&D portfolio. So there is the FX R&D, which contains only the currency futures. And if you go to portfolio vol, and you can see this one, the first one is just the base portfolio, so you don't look at it. And the second one, when it's which says like R&D, these are the ones that you wanna look at. This is the FX R&D, and it says that you use in it euro, pound, Australian dollar, Canadian dollar, and yen futures. So this one is like about $10,000, so it's much less than the global macro R&D in the sense of margin. This one is light R&D, and it contains just all the currencies beside the yen, and then there is also the ZN and the Euro Stocks index, and the lightest one, which is like, I don't know, like $6,000, something like that, is the margin R&D portfolio, which is just euro, pound, Canadian dollar, and gold. Okay, so this one is like the least margin is required in this one, and the largest amount of margin required is in this one. Now, the performance of those different portfolios is, from the perspective of a year or 2 years, it's pretty much the same. Like, I mean, not the same, but the angle of a performance and the volatility of these portfolios is pretty much in the same direction. So you should be fine if if this global macro works in the future. These one will work too. Okay, so you're definitely going to see the least volatility in this one, in the global macro, because there are a lot of hedging parts in it. Probably the most volatile is going to be the FX, because it doesn't have these treasuries, the equities part in it. So maybe there is this one is the most volatile, and then probably the margin is the FX and the margin R&D are the most volatile, and the light R&D and global macro are like very, very similar, but this one, the light R&D, just requires a bit less capital. Now, some of you asked me if we can use it on different instruments than futures, and the answer is of course yes. But please understand one thing, that you have to really pick the right size of the instrument that you're trading in this portfolio. So you gotta recreate this this table like one-to-one. So for example, if you would go with CFDs, right, because a lot of people are trading CFDs with some forex brokers or something like that, they don't use futures, and that's fine because you have a leverage there and you have much less margin required for these products. And the only thing that you have to do is recalculate. So you have to trade like 1/10 of euro, 1/10 of British pound, and everything has to be according to this. So you can go look to the table of specifications for the contract, like for Canadian dollar, and see what is the tick size there, and all the others, and see how you can recreate it with your broker. And we have a table for that, and I will post it somewhere. One of the members of our group made it for some of the most popular forex platforms, and you can, and you will be able to see how would the positioning correspond on the CFDs with the much less capital needed for this. Yeah. So basically, if you, for example, choose to trade the just the currency R&D portfolio, you use only these instruments, right? The euro, GDP, Aussie, CAD, and yen, and you have the positioning here, right? So it's the same positioning as over here, but you just choose to trade only these 5 instruments, and always you look for the direction which you should have is in this table here or over here, right? It says the same, but please do not use the base model. You want to use the R&D model to trade. There is also like the what filters are used in the R&D model, but I'm not going into details of it right now because I don't want it to take too long time. Also, the other question that is that I get often is, so when do I start trading it? Like, because you can see that clearly the portfolios are really high right now, and that's how it's supposed to work, right? It should go up and have some periods like this. This is the COVID period, which really was very volatile if you compare it to the rest. And so when do you start? And this is why I've made this tab, the portfolio vol, because as you can see, you have here some averages, like these green lines, right? Because the performance is the white line, and here you have some green lines, and also the indicator below it, which shows the sort of implied volatility for these markets that you're trading in this portfolio. And like, of course you can get in anytime you want, but you can clearly see that this is not like a straight line up. You will have some dips, some periods of consolidation. It's like any other like instrument, except that it mostly goes up. So I've made these things so you can sort of gauge where would it be most probable to have the least risk involved in getting in this portfolio. Because if you look at it from this perspective, what you actually do is you trade this sort of virtual instrument, right? Because these are actually the prices of these components of these instruments, but traded in different directions from changing in time, right? So you can actually use some kind of technical analysis to analyze this, to see that if it goes into its average, it will probably bounce up again. So there are two things that I would consider if I want to find the best risk reward entry to get in these portfolios. And whenever this volatility indicator goes to this orange zero line, it's a good opportunity to get in, right? Whenever it's close to the zero line, it's a good spot to start trading or add to your positions. Or if it usually corresponds with the indicator getting to the zero line, it usually corresponds with the equity performance line to actually get to its average, the one of these green lines. But to tell you the truth, of course, if you're starting with the full sized futures, it might be reasonable to start exactly at these points, right? But the purpose of this portfolio is to grow in a year, in 2, 3, and it won't really matter actually when you get in with your first positions, because the goal is to compound the the equity here. So in the sense of, from the perspective of like I said, months or years, you will actually want to get in to these portfolios, or scale in or add to your positions at some point for sure. Of course, having said that, there is a danger that this model at some point will stop working, because it's just a model, right? And this is something that I should probably tell at the very beginning, that if there will be some, I don't know, like economic paradigm shift, that everything will start work in a different way. And I don't know what would have to happen, but probably something really dramatic. Like, I don't know, they will peg the dollar to gold. I don't know, like, who knows what will happen in next year or 2 or 5 or whatever. But we'll know about it. We'll know for sure that something big happened in economic and fundamental space, and probably the model will stop working, because because the premises that it's based on will not be applied anymore. And also, this is why you can always or you should always monitor the performance of it. I mean, it never broke down below its average, this one, the green line, right? And if it will at some point drop below it, then I will consider that, okay, something changed with the model. So you have like a sort of a stop loss for this, because it should generate stable returns over time like this. And whenever it drops below its average, I would consider it like, okay, stop trading now with this model and wait until it until it solves, until it goes back up above the average, and research, and that's what we did at some point actually with the base model, right? We saw that, we saw this thing here, and that's your basically like that would be a stop, So there was something going on here, and it's actually the COVID situation, right? And this is the last thing that we changed, during a lifespan of these portfolios, because I'm not gonna get into the details, but there was a big thing about $1 that really impacted the model, and I didn't see it coming before that. So it's always a work in progress. But as far as R&D right now, I believe that for these times and things that already happened and might happen in near future, I mean, I think we're good. Like the model really have all these moving parts together, like what is the most likely to be going on in the in central banks heads, what can happen with institutional traders, how they probably will react on the data, because basically I believe that they see the market pretty much the same way in the global macro perspective. This is how probably, I'm not bragging here, but this is probably how like Goldman Sachs people are seeing the reality of investing in this environment, looking at right now, because it is impossible to build the optimal model just by guessing, while you have so many different economic data, because this is like about 50 different reports, right? 50 different reports with lots of numbers, and you have to make the model so every number is related to each other, right? So the probability that you will come up with something like that just out of a random luck is impossible for me. That this model has to somehow represent what the financial reality of a country's economy really is. And the very important thing also here is you will see in the charts FX portfolio tab, there is something like this, the macro scores, right? So you will see like US dollar, so United States is 1, euro -3, and so on. So this is basically all the model, because the model works like a scoring board. So it will take all the data that is needed, all the fundamental data, and it will give a score to the country, to the economy. And if you look at it, you shouldn't look at it like, okay, if the if for example, Canada has +5, which is really a high score right now. It's not that it doesn't mean that it's so good in Canada. I mean, I don't know how it is in Canada right now, but you have to understand that the financial reality of investing is in most cases it's totally different than what is like your perception of of a country's condition. Like it's like what the media tells you, for example, and what is market doing actually, right? So the model is the trading reality, like investing reality of the numbers that are calculated in the model. But what you feel about the country's condition, economic condition, what the media says, it's totally, a lot of times, totally different reality, right? But it's pretty natural, I think, and pretty basic. Okay, so what did I forget to tell you here? Yeah, you can also here you can also see the major economics macro score, and this will also change in real time. Like the day that there are some news. Some new data coming in, you will see that these bars are going to change in real time. But like I said, the your trading decision to reposition or something like that is going to be right here. You always have to be positioned the same way, in the same direction as it is stated right here. One thing about those equity lines is it is calculated just with single contract, right? There's, like I said, there is no compounding here. So if you would start the global macro R&D like 2 years ago, it's actually showing exactly 2 years. So you would have to put like, I don't know, like $25,000, probably something like that. The margins were a bit lower back then because right now, as you know, the margins are higher. But let's say you put in like $30,000 to open these positions. And right now the without oil it's like $266,000 trading just one contract, right? But you probably want to reinvest your capital, and actually the member of our group, he made Google Sheet, which I will maybe put a link in the description of it. Let me pull that out. Yeah, okay. So these are all the 4 different portfolios: the global, FX, light, and margin. All of the R&D portfolios, right? And what he did is, actually, if you have if you have a starting deposit here, which is 30,000 for global macro, 10,000 for FX, 25,000 for light R&D, and so on. And he actually added this compounding feature, that every time you get your initial deposit 100% more. So if you make another $30,000, you trade with 2 contracts now. Okay, so every time you make $10,000 in FX, you add one more contract, right? So you can see like, the numbers are really crazy. Like if you start with the global macro and start with $30,000, and every next $30,000 you add one more contract, so you will see like how many contracts there is, and like to this day it made like $51 million and $434,000. Like the numbers are crazy, but I'm not showing this to for you to like inspire you to get in with all your money, because actually this is very aggressive, right? But the data, it's not fake. It's totally automatic. It's based on macro, and it's not like over optimized or whatsoever, because the base model really didn't change that much. The core idea of this fundamental landscape is based on pretty solid thinking process. So I believe that it is doable. I didn't do it. Like, don't get me wrong. I didn't compound such numbers whatsoever, because I believe that the best way to use it is to take out some of the profits regularly, like every 2 months, every 3 months, even every month, if there are, because there are usually every month you're pretty positive on your equity. So it would be very wise to take out half of the profits, or 1/4 of the profits. Like I leave it to you, because you see the potential, what it has. You see the the volatility of it and what can be done with it. But I guess it's really very interesting that if you're dreaming about trading a large size, like, do you really think that you will ever be able to trade, like, I don't know, like almost 2,000 contracts of euro futures, or whichever one, on intraday basis? Like, I don't know, scalping is like, definitely it's not gonna happen, and I cannot imagine myself doing like intraday trading with this size, like to jump in the market to get 5, 10, 15 even points with this size, because I think that you would have to have balls of not steel, but some kind of a metal that is not invented yet. I know some people are doing it, of course, but most of us is never going to be able, even if you would have such amount of money, you're not going to be mentally able to trade that size. I think the only way that it might be possible is to trade it like this. Like you have 1 or 2 repositioning during the month, and that's all you do, and you just monitor. And one other very important thing is that you should build it from the ground up. Like, you should build it from the deposit that you really can afford to lose, like with every investment that you do, such kind of investment, like such speculative investment. You should put the money that you really are able to lose. If you don't have $30,000 in deposit, which for the matter, I don't really have this kind of a money that I can lose. I really wouldn't like to lose $30,000 or whatever, and and I would use CFDs for this, and I actually use CFDs for these portfolios, right? Because it's, I understand it's a lot of money, so for most of us, right? But the potential is there, and it's automatic, and that's what I love about it. It's just I've decided to give it a shot, and it went really really well for months, and then the COVID situation happened, and we just cut it off, and I stopped trading the R&D until some time ago, because I wanted to see, okay, if everything is stable. So I ran a backtest with all the new assumptions there, and it looks stable in the past, and now we made a forward test, and it works great. So I'm back at it, and I hope that it's gonna be next couple months are gonna be the same as these ones. So yeah, I just wanted to be honest with you, because if somebody shows you these numbers, it's like, okay, man, why not you're a billionaire or something? Like if you look at these numbers, like it's 200 millions, 150 million. I mean, so I'm being honest with you. This is something that I'm working on for last couple of years, and I'm not like a natural macro trader, but I believe that this is at the end, this is the way that you probably want to go with your trading. Like, okay, we can trade intraday and do all this technical stuff, but my goal is to master this fundamental thing, this macro trading thing, because most of people, and I thought that too, thinks that, oh yeah, this doesn't generate the percentages that really makes you tick, right? But if you look at these 2 years, it's like, man, I would never touch intraday trading if I would if I would be trading this at this level of performance, because why would you it's more than enough, right? Okay, so I'll probably start a group, because we already have a group of people who is working on developing things, putting in some ideas, putting in some work also into this, and this is a pretty old group that we have. Like we have it for a couple of years now, but the problem is it's in Polish, it's not English group, and I will be probably doing some kind of a board on my website, so that we can communicate easily, and other people will see that communication, other subscribers will see that communication, because I'm sure there are still a lot of questions here, maybe some new ideas about it, and I want it to be in one place where everyone can see it, and maybe somehow help each other out with when somebody still doesn't understand it, or well, it anyways, it's probably a good thing to have a place like that, and not communicate only through emails or on Twitter or something like that. Okay, so again, it was supposed to be like 10 minutes long, and it's over in an hour now. Okay, I hope it clarifies the whole concept a bit more. If you have any question, like always, contact me through email or contact form on the website, or through Twitter, or whichever channel you will find. And I'll talk to you in the next video. Probably it's gonna be about the intraday setup, because we've added some new features there. You have a structural ladder, which is pretty crucial, and yeah, I'll be talking about that soon. Okay, take care, everyone.